morning, and thank you for being here. The committee's investigation into Bank of America's acquisition of Merrill Lynch has resulted in an unprecedented look behind the scenes of one of the biggest bailouts in American history. The government forced Bank of America to go through with the merger. Every Bank of America senior executive involved has told the committee that the government to go through with it. In fact, they told us they decided to go through with it, the deal, because they thought it was in the best interest of Bank of America and its shareholders. Ken Lewis also testified that no one in the government did anything improper during this transaction. If there are still people who want to say the government forced Bank of America to go through with the deal, they are turning a blind eye to the facts we now have before us. Over the course of this 8-month investigation, the committee has held 5 hearings, received extensive testimony from top executives at Bank of America and senior government officials, conducted numerous interviews, issued 2 unprecedented subpoenas to the Federal Reserve for internal records, and reviewed nearly 500,000 documents. Most importantly, public scrutiny and oversight by this committee has produced tangible results. Today, 2 days ago, Bank of America paid back its entire $45 billion federal loan plus interest. In addition, under pressure from the committee, Bank of America agreed in September to pay $425 million to the Treasury Department in compensation for toxic asset insurance the bank received, but never paid for. In sum, our bipartisan investigation has resulted in the American taxpayers receiving approximately $47.5 billion. Even in today's world, that is real money. And every member of this committee should be proud of our efforts. And I take the time to salute you for your involvement and your hard work, and it's been great to get to this point. While we have thoroughly examined all these issues involved in this case, I agreed to grant the ranking member's request for one more hearing to tie up some loose ends that he is concerned about. This will close the committee's full, fair, and successful investigation of the Bank of America Merrill Lynch merger. On that note, I thank you, and I yield to the ranking member of the committee, gentleman from California, Congressman Darrell Issa.
Thank you, Mr. Chairman, and thank you for holding this hearing. I've already told the chairwoman that, quite frankly, I do believe she's the bookend of this investigation. She's the bookend because Tim Geithner has never appeared before us. She's the bookend because, in fact, there never really was much there. Bank of America is a regulated bank. Monies were made available on an extraordinary basis and have now been paid back. Today, in the short time that we will take of the chairwoman, we in the minority will ask, where do we go from here? The security of our banks, FDIC-insured banks, the future of banks conveniently becoming banks in times of trouble and perhaps not being banks in other times. These are important questions that this committee should ask, not because we're the Financial Services Committee, but because we are the watchdog of the American dollar and the American process and the laws that are passed that the executive branch and its affiliates must adhere to. Mr. Chairman, I'm deeply concerned that in your opening statement, you quite understandably said that the American people were paid back $45 billion with interest over $47 billion. I must caution you, the American people didn't get a penny back. That money has not come back to the American people. In fact, it's simply been put back into the slush fund that was created under a Republican president with Tim Geithner and Hank Paulson's assistance, and today, in fact, not a penny has been paid back to the American people. That money is being recycled into do-good causes or whatever the President and this administration would like to do. Mr. Chairman, I look forward to us getting the American people's money back as it was promised. We were told that, in fact, we would be paid back all of our money and probably with interest. Mr. Chairman, unless that money comes back immediately, when you look at Chrysler, General Motors, and, of course, $31+ billion to AIG that Tim Geithner himself has now said we will not get back, it is clear that even if all the other monies given to various organizations through a process of buying mostly preferred debt, if in fact all of that is paid back with interest, the offset of the money that we now know we're going to lose would barely make us whole without considering interest as anything other than principal payback. So, Mr. Chairman, this is the bookend. We have only a few questions for our esteemed witness, and we appreciate your bringing her here today. But this is not the end of protecting the American people's money, not the end of this committee's jurisdiction of ensuring that the intent of law becomes the fact in law. With that, I thank the Chairman and yield back.
I thank the gentleman for his statement, and that maybe what we can do is that with some of this $47.5 billion, that use it to create jobs and job opportunities. So maybe that's a good way to use it.
Mr. Chairman, I would certainly appreciate a bill authorizing that and appropriating that through the Congress, and I look forward to working with you on such a piece of legislation, which is our constitutional responsibility.
Thank you very much. Appreciate the gentleman's, and I look forward to working with you.
Mr. Chairman, would the ranking member yield for
Actually,
if the chair certainly could.
would the chairman allow me to just respond to something the ranking member said?
Very quickly.
Very quickly. I just want the ranking member to know there are members on this side of the aisle who share his view about the need to address the deficit, and that the first obligation of the repayment of TARP money or the use of unused TARP money ought to be that.
Thank you.
Yeah. Thank you very much. This hearing is being conducted by the Domestic Policy Subcommittee, of course, and they have done a superb job in working with us on this issue. And I now would like to yield 5 minutes to the gentleman from Cleveland, Ohio, Mr. Kucinich, the chair of that subcommittee.
Thank you very much, Mr. Chairman, Mr. Rice, members of the committee. On December 5, 2008, the shareholders of Bank of America voted to approve a merger with Merrill Lynch. Only 12 days later, Ken Lewis, CEO of Bank of America, made a call to then Secretary of Treasury Hank Paulson, initiating a process that led to a $20 billion bailout of the merger and a promise of government insurance for losses up to $118 billion. The chronology of events strained belief. Was it true that the financial situation at Merrill Lynch shifted so dramatically in that short amount of time, as Ken Lewis said? Or did top management know, or should they have known, about the deteriorating situation at Merrill Lynch much earlier? Did they fail to make necessary disclosures to shareholders? Bank of America would be in legal jeopardy if it failed to disclose to shareholders information about large accelerating losses at Merrill Lynch, known or knowable before the shareholder vote. The Domestic Policy Subcommittee investigation has found evidence of possible security laws violations at Bank of America. Bank of America unreasonably and negligently relied on internal fourth quarter 08 forecast created by Merrill Lynch that omitted any forecast of how the CDOs, CDS, and other toxic assets would perform during the quarter. The former Merrill CFO admitted that this forecast was not, in fact, a valid forecast. Bank of America knew at the time that the forecast was of questionable validity. However, Bank of America did not do any actual financial analysis to make up for the Merrill omissions. Instead, Bank of America merely pulled a number out of thin air, which was recorded on a forecast as the gut feeling of Neil Coddy, Bank of America's chief accounting officer. Bank of America simply created an assumption that Merrill Lynch's illiquid assets would almost break even for November, thereby spreading October's bad results over 2 months. The attorneys at Bank of America and at Wachtell Lipton recklessly did not question this financial information. They advised Bank of America not to make further disclosures to its shareholders based on the deficient forecast and the gut feeling. Within only weeks, however, reality crowded out wishful thinking. Merrill Lynch's exotic investments continued to lose large amounts of money causing Merrill to lose over $21 billion in just the fourth quarter. Bank of America went running to the U.S. government for rescue. When I asked Ken Lewis about this at our first hearing, he told us that he relied on advice of counsel. Protecting shareholders is often, in the final instance, the responsibility of corporate general counsels and their outside counsel. The subcommittee's investigative findings demand the question, where were the lawyers? Where were the lawyers? The glaring omissions and inaccurate financial data in the critical November 12 forecast, so obvious that they should have alerted the attorneys to the necessity of reasonable investigation before making a decision on Bank of America's legal duties to disclose. The apparent fact that they did not mount such an investigation makes the decision not to disclose Merrill's losses to shareholders an egregious violation of securities laws. The stage for these possible violations was set by former SEC Chairman Christopher Cox. At exactly the time that CDOs, CDS, and other exotic instruments proliferated in financial markets, Chairman Cox discouraged formal investigations of and large corporate penalties against securities fraudsters. Bank of America's conduct was the corporate reaction to years of weakening enforcement at the SEC under Chairman Cox. Chairman Shapiro has made efforts to turn enforcement policy around. While I applaud the SEC for enforcing the law, in the case of the non-disclosure of the Merrill bonuses, Bank of America's failure to disclose accelerating losses at Merrill Lynch before the shareholder vote is more significant. Indeed, those undisclosed losses dwarf the amount of undisclosed bonuses. The reliance on counsel defense asserted by Ken Lewis raises the broader question, will the Securities and Exchange Commission allow corporate management to rely on the advice of counsel defense and then allow the counsel to avoid liability for their advice? The investing public, and now this congressman wants to know, where is the SEC? As of yet, we don't know. Thank you.
Thank you, gentlemen, for a statement. And now you have 5 minutes to the ranking member of the Domestic Policy Subcommittee, Mr. Jordan from the state of Ohio.
Thank you, Mr. Chairman, and I want to thank you for holding today's hearing. I look forward to exploring the role of the SEC and the FDIC in the merger between Bank of America and Merrill Lynch. This committee's investigation has revealed important evidence of the abuse of power by the federal government in response to the financial crisis. As I've said before, Mr. Chairman, while the actions of the government officials took place in a time of significant economic challenges and uncertainty, there must be limits to government action, even in a time of crisis, and those limits must be respected. We must also keep in mind that the actions of government officials in this merger occurred after many of the nation's banks were forced to accept taxpayer money through the TARP program. We know that in October 2008, this is from testimony Ken Lewis gave us the very first hearing we had on this issue, we know at that October 2008 meeting, Mr. Paulson, Mr. Bernanke, Mr. Geithner, and Ms. Baer brought the CEOs of the largest private banks in America to the Treasury Department, demanded that they accept the partial nationalization of their banks in exchange for an amount of money of the government's choosing. We look forward to learning more about Mrs. Baer's role in that meeting and this entire affair. This investigation has continued to reveal the unintended consequences and negative implications of the government's unprecedented intervention in the private sector. I hope that the Congress will apply these lessons as we continue to debate the appropriate regulatory framework for our financial system as we move forward. And with that, Mr. Chairman, I thank you and yield back.
Thank you very much. We now move to our witness. We have with us today the chair of the Federal Deposit Insurance Corporation. Madam Chair, it's long-standing tradition that we swear all of our witnesses in. If you would stand and raise your right hand. Do you solemnly swear to tell the truth, the whole truth, and nothing but the truth? If so, answer in the affirmative. Right. Let the record reflect, you may be seated, let the record reflect that the witness answered in the affirmative. You may begin with your testimony.
Chairman Towns, Chairman Kucinich, Ranking Members Issa and Jordan, and members of the committee. As requested by the committee, my testimony today will focus on the FDIC's role and the decision to
Madam
provide...
Chair, you want to pull that mic down just a little bit there?
Sure. As requested by the committee,
And closer, I think, too.
As requested by the committee, my testimony today will focus on the FDIC's role in the decision to provide assistance to Bank of America. Let me note at the outset that Bank of America is an open institution, and the FDIC is very sensitive about any discussion of the condition of open and operating insured depository institutions. In mid-September 2008, in the wake of Lehman's failure, B of A announced that it would acquire Merrill Lynch. B of A's acquisition of Merrill Lynch was approved by the Federal Reserve on November 26, 2008, and was to be finalized in early 2009. However, on or very shortly before December 21, 2008, the FDIC was told by the Federal Reserve and Treasury that B of A had expressed reservations about completing the acquisition of Merrill Lynch. Over the course of time, it was clear that officials from the Federal Reserve and Treasury believed that systemic risk would exist absent an agreement by the government to provide assistance to B of A. On January 14, 2009, the FDIC received from the Federal Reserve a draft term sheet describing an assistance package, the principal elements of which were a capital infusion and a transaction where the FDIC, Treasury, and Federal Reserve would share in a guarantee against certain losses, otherwise known as a, quote, ring fence, end quote, transaction. The FDIC continued to analyze where and how much the exposures were and how that specifically impacted the FDIC. The FDIC's board ultimately was persuaded that B of A's condition presented a systemic risk and that the ring fence transaction would mitigate that risk and the risk to the Deposit Insurance Fund in a cost-effective manner. The transaction also limited the FDIC's risk to a small portion of the covered exposures, recognizing the fact that most of the exposures resided within the investment bank and not the insured depository institution. On January 16, 2009, the planned Treasury capital infusion and the Treasury-Fed FDIC ring fence transaction were announced. In early May 2009, B of A asked that the ring fence transaction not be completed. Moving forward, we have worked continuously with Congress, the Treasury, and the financial regulators towards creating a more resilient, transparent, and better regulated financial system, one that combines stronger and more effective regulation with market discipline. One of the lessons we have learned over the past few years is that regulation alone is not enough. We need to establish an effective and credible resolution mechanism to ensure that market players will actively monitor and keep a firm handle on risk-taking. We commend you and your colleagues in the progress you have made in moving towards providing the regulators with the tools to effectively deal with any future crises. Thank you, and I will be pleased to take any of your questions.
Thank you very much for your statement. And let me just say to the members, we're going to be really tight on the 5 minutes today, because 5 minutes really means 5 minutes to me, which means 5 minutes to ask the question and for the person to answer the question, because I promised the chairperson that I would have her out by no later than 11:15, 11:20. So we want to sort of respect that and try to move forward. Let me just sort of ask one quick question. Are there steps you think the Congress can take to avoid future bailouts of the banking industry?
Yes, I think we have put a very high priority on a robust resolution mechanism. We have that for insured depository institutions, and when smaller institutions start to fail, they are put into a very severe resolution mechanism that requires shareholders and unsecured creditors to take loss, generally complete loss. For non-bank entities or activities outside of banks, this resolution authority does not apply, and we think something very similar to the FDIC process, which is shareholders and creditors take losses, not the government, is very important. And we think that the House bill that is being on the floor now moves very well in that direction. And we think this should be very clear, and that the resolution authority should specifically ban assistance to individual institutions going forward, and I believe that is also in the House bill.
Thank you very much. I now yield to the gentleman from California, Ranking Member, Congressman Issa. Thank you very much, Madam Chair.
Actually, Mr. Flake wanted to be recognized first.
The gentleman from Arizona. He yields to the gentleman from Arizona, Congressman Flake.
I yield. The gentleman from California.
Okay. The gentleman's yielding me his time in order to be expeditious. Madam Chair, I want to be brief also, and I've got just a series of short questions. First of all, from the standpoint of the FDIC, looking back now, forgetting about whether the merger was a good merger, the MAC, all the other things that this committee has worked on, wasn't the underpinning of the additional money, preferred stock as a form of loan, wasn't that in fact the most appropriate thing for the FDIC to approve of so that the capital worth of Bank of America would be undeniable?
Well, I think it's always hard in hindsight to answer questions like that.
Actually, I normally find it easier in hindsight. I'd hate to have
Maybe easier in hindsight. Well, I guess it's easier to reevaluate decisions that were made. I think a distinction needs to be made between the insured depository institution that had a strong capital position with other activities that were going on in the bank holding company. And so I think if you're looking just at the insured depository institution where we had the exposure, there's a question about whether additional capital was needed. I do think that.
No, and I'm not saying whether it was needed. It's clear that in hindsight,
Right.
it's clear they didn't need it because they paid it back to you essentially without it being from actual new money in any large amount. They passed the stress test, and they passed the stress test and said they could pay it back. So I know that part of hindsight is
Right,
clear.
right.
But the real benefit of the $45 billion of loan, and I repeat, it's not, we didn't bail them out, we didn't give them anything. We bought stock, we bought the worth of the company,
Right.
and we got interest guarantee and the ability to get our money out ahead of everyone else. Preferred stock is not all bad. But the effectiveness of it was to, if you will, over-capitalize the company in hindsight, but wasn't that essentially a good thing in that if there was no other benefit to TARP, the confidence of knowing that these particular banks were extremely well capitalized, not as to the stockholders,
Right.
but as to the depositors, wasn't that effectively the good thing that came out of this arrangement?
Well, I think, yes, the capital investment certainly created a fortress balance sheet. I think that was the original intention of all these capital investments under TARP. Again, we were not, the only role that we had was on the ring fence, not on the TARP investment. That was a Treasury program, a Treasury decision. But yes, certainly.
Okay, but you were the beneficiary of it, in a
It's absolutely
sense.
going to have a stabilizing impact, yes.
The next question is the harder one. Many banks and many non-banks decided to become banks conveniently in this
Right,
crisis.
right.
Many entities, in fact, fled to the FDIC, and the FDIC finds itself with its funds which are designed to ensure that we never have to actually put in taxpayer dollars. Those funds are stressed right now. Going forward, do you believe that, in fact, in the future, people should be able to run to the FDIC, run to being a bank when it suits them, even if they hadn't been when it didn't suit them?
No, I don't think they should be able to do that.
Is
Absolutely.
that a reform that you presently see on the horizon that would give you that ability next
Yes.
time to say, you better be there early or not come at all?
Well, I think two things. I think we need a robust resolution mechanism so when entities get themselves in trouble, they don't get government assistance, they get put into receivership. And I think entities asking for assistance maybe won't ask for assistance so much if they know that that is the repercussion. In terms of entities becoming bank holding companies and having insured depository institutions, not just for deposit insurance, but for the Fed lending facilities, we have suggested that there needs to be a systemic risk council that would decide and have the power to say to an entity that became a bank holding company, but perhaps later doesn't want all the regulation that entails, that they still need to subject themselves and be subject to prudential supervision, that they can't arbitrage just becoming a bank holding company when it suits them and then not, and escaping the regulation when that suits them.
Thank you. I
Absolutely.
yield back to the gentleman from Arizona. And he yields back.
Yield back.
I yield back.
Yeah. Thank you very much. I now recognize the ranking member, I'm sorry, the chairman of the Policy Committee. Yes, Mr. Kucinich from Ohio.
Chairman Baer, do you have any concerns that America may face yet another bank collapse?
No, I don't, but I think there's a lot of work that needs to be done to continue the stabilization and the cleanup, and I think the regulatory reform efforts going on right now in Congress are absolutely crucial to that.
Do you think banks that are too big to fail are too big to exist and ought to be broken up?
Well, I think there needs to, the problem with too big to fail is the same problem that you had with Fannie and Freddie. There is an implied government backstop, which feeds into risk-taking. If shareholders and creditors think they have the upside and the government has the downside, that is going to encourage risk-taking. We think that's a major factor that drove the crisis. And again, this is why, I hate to sound like a Johnny One Note, but we really need, Congress needs to establish a very robust, very severe resolution mechanism that tells shareholders and creditors they will take losses if these institutions go down. Right now, they're just happily, feeding, extending credit and making equity investments, and I fear that they're not really doing their own due diligence in terms of looking what's going on in these very large institutions. Do they understand the risks? Do they understand, is the management on top of those risks? I don't think we have market discipline right now, and we need that.
Do you have any concerns that banks may be still over-leveraging derivative markets?
Absolutely, yes. I would say
And
financial institutions, not.
Pardon?
I think banks is a loosely used word. I would say financial institutions, or I absolutely have that concern, yes.
And what can you tell the American people about the security of their bank deposits?
Their bank deposits are very secure. That is one thing we have been very early on with a public information campaign. The resolutions have been smooth. Everyone's deposits have been completely protected, as they always have been. So there is no question that the FDIC has resources to deal with whatever may come.
Would you tell us what those immediate resources are to assure security of deposits?
Right. Well, we are full faith and credit, and we have a Treasury line and a congressional commitment to back insured deposits. And again, that's been in effect for 75 years. Right now, we have required prepayment of assessments. That's going to bring in another $45 billion at the end of the year, which will bring our cash position probably in the first quarter to around $60 billion, given what we already have and additional monies that we're going to be bringing in. So I think it's a very strong cash position. We can borrow up to $500 billion from the Treasury Department if we would need to do that. I don't foresee any circumstance where that would become necessary.
Thank you, Madam Chair. Thank you, Mr. Chairman. Yield back.
Thank you very much. Now I yield to the ranking member of the full committee.
Thank you.
Councilman Issa.
And I'll be equally brief this time. Madam Chair, you on January 9th determined it is clear that, I'll quote it, "It was clear that officials from the Federal Reserve and Treasury believed the systemic risk would exist absent an agreement by the government to provide assistance to B of A." That's really the point at which you came in. But isn't it true that the deal was already done prior to that time to give them the money? Isn't that what we've essentially discovered?
Right. Well, I will tell you, I know conversations that already occurred between the Treasury and the Fed and Mr. Lewis prior to the time we were contacted. I wasn't privy to those conversations, so I don't know.
I realize that we've been very unfair to you in that you came in on the tail end of
Right,
everything,
yes, we did.
and only if something was a bank or about to become a bank holding
Right,
company.
right.
Well, let me follow up with this question, specifically in your role as FDIC chair. If you had a choice, and you were told, what would you like to do? When B of A said, we're going to evoke the MAC or give us more money, it doesn't matter who said it, but that
right.
occurred. Wouldn't the FDIC's position in the future be, go to Congress or go to the TARP and bail out Merrill Lynch directly? This, if they don't want it and there's money needed, and obviously there wasn't new management or consolidation in the merger at all, wasn't it really go bail out Merrill Lynch, do whatever you're going to do with Merrill Lynch? They're not a bank, and why should it be clouded with me? Isn't that essentially the FDIC, you and future chairs' position that you would prefer?
Well, we think it's important to act as one government, yes, but I have my first job and foremost job is to protect insured depositors, and I can't, with at that time, about a $50 billion deposit insurance fund, bail out the entire economy and everybody else with the resources that we have, and I have to make sure that we have credibility to protect insured depositors first and foremost. So yes, investment banks are not insured depository institutions, and it would have been nice to have other mechanisms available, absolutely.
So as we're Monday morning quarterbacking up here, if there is anything that, and since we've determined that Chrysler and General Motors qualified for TARP money, if there's any mistake made, it was this very lucrative merger that B of A is now happy about and touting. To be honest, when faced with the dilemma, it was a Merrill Lynch decision. Treasury, Paulson, Geithner, they should have made a Merrill Lynch decision relative to Instead, what they do is they pushed it onto a bank holding company, and a bank holding company then had a systemic risk problem, which fell to your doorstep, and $45 billion of taxpayer money, albeit paid back, in fact, was put in play.
Well, yes, I mean, B of A was already a bank holding company, obviously. This is a situation where Merrill Lynch was not. So through the acquisition, it got folded into the bank holding company structure. And yes, there were significant benefits that accrued because of that, yes.
Now, on a lighter note.
Okay.
Yesterday, this committee, on a bipartisan basis, moved for a common searchable platform, although not XBRL, which of course you use. We mandated a common uniform platform with rigorous structure so that there could be transparency either to those cleared or, in the case of assets or information available normally to the public, directly to the public. What is your experience, and what would you guide us with, in your case, XBRL and that kind of capability that it gives you to look down and, if possible, even allow others to look down?
Right. Well, IT is not my forte. We have we have been leaders in this area, and I think we've had a very good experience. And I would certainly offer our IT people to give you a more detailed briefing on that, if you would like.
But let me, last follow-up question, and I'll yield back. Do you believe that this committee is on the right track when we insist that databases be common, robust, searchable, and interactive so that, in fact, when appropriate, the American people can have transparency?
Right. Well, you may get me in trouble with other agencies, but if I could just follow back, we've had a very positive experience, and I would encourage others in this committee to facilitate broader use.
Thank you, Madam Chair. I yield back.
Thank you, gentleman from California. I now yield to the gentleman from Maryland, Congressman Cummings.
Thank you very much, Mr. Chairman. Ms. Baird, welcome, and thank you for doing such a superb job.
Thank you.
I recognize that the FDIC's role in the Bank of America bailout was different than that of your fellow regulators at Treasury and the Federal Reserve. But nonetheless, we have a responsibility to explore all aspects of this tainted transaction. In your written testimony, you note that the FDIC was notified of potential government assistance in the Bank of America Merrill Lynch merger around December 21, 2008. You go on to say that over the next 3 weeks, the discussion continued about Bank of America's financial condition and the nature of the assistance to be provided. You discussed the case with Secretary Paulson, Chairman Bernanke, and others on January 9, 2009, and were provided a draft term sheet on January 14th. This is all correct, I hope, and I'm working from your own written testimony. Is that right?
That's right.
My concern is the fact that in the past hearings in this committee, we have heard about how Ken Lewis briefed his board of directors on December the 22nd, 2008, and again on December 29th, 2008, indicating that at least $12 billion in fourth quarter Merrill Lynch losses would be covered by the federal government. I'm not asking you what happened at those meetings. I know you weren't there. But what I'd like to address is this. Do you have any reason to believe that Ken Lewis had sufficient basis on the structure of any potential deal to brief his board with such certainty?
No, again, we weren't privy to any of those discussions, and certainly the FDIC had made no decision at that time about whether we would participate and to what extent we would and how that would take place or whether it was necessary.
And based on your testimony, the government regulators were still reviewing the Bank of America positions and working on whether a deal would occur well into the new year. It certainly doesn't sound like it was a done deal, does it?
No, and again, I can't, we were only a small piece of this. But
Right.
certainly from the FDIC's perspective, we had committed to continue talking with the Fed and Treasury and examine the facts and analyze to what extent assistance would be appropriate. We had not made any decisions during that time period, no.
Well, this is not you saying this, is me saying this.
Right.
One could certainly read this as Mr. Lewis pulling a fast one on his board to get them to approve the deal. Unless you want to comment, I will yield back.
I'll stay away from that.
I'm sorry?
I think I'll stay away from that. Thank you.
All right, thank you very much. Thank you, Mr. Chairman, and I yield back.
Thank you very much. Thank you, gentleman from Maryland, for his questions. Now you yield to the ranking member of the committee,
Thank you,
Mr. Jordan.
Thank you, Mr.
Ohio.
Chairman. Chairwoman Baird, let me, I've looked at your record, and professor of regulatory policy and very impressive. And I'm just curious, in a broad context, are you, like I am, a bit troubled? Frankly, for me, it's more than a bit troubled by this, what I've called unprecedented involvement by the government in the private sector, whether we're talking President of the United States deciding who gets to be CEO of General Motors, whether we're talking about the fact that we now have in the United States of America something I thought I would never see, but a federal government pays our telling private American citizens how much money they can make, and bailouts and TARP and second stimulus coming in, on and on it goes. So just as a accomplished professional individual, I mean, are you nervous about this general direction and, again, this unprecedented involvement of the government in the private marketplace?
Absolutely, and we think better tools are needed for the government to deal with this in different ways going forward. We're very much opposed to, and I believe the House bill does this, prohibits capital investments in banks and financial institutions going forward. I think government ownership of financial institutions has created not only a lot of public outcry and cynicism, but also very difficult issues about what should be private entities in private sector decisions, based obviously on some prudential regulatory standards, but government ownership has created a whole host of problems, and we would like to end that as going forward.
Okay, with that being said, let me take you back to, and this again, as I pointed out in my opening statement, was brought out in when we first had Ken Lewis in front of this committee several months ago. The meeting that took place here in D.C. with the 9 largest banks 10 days after the TARP legislation was passed. And again, the TARP legislation was passed designed to go in and get these troubled assets off the books, free up credit, free up balance, straighten up these balance sheets, et cetera. 10 days later, the 9 biggest banks were brought to the nation's capital. According to Mr. Lewis's testimony, Mr. Paulson, Mr. Bernanke, and you were in that meeting. And Mr. Lewis indicated he had no idea what the meeting was about. That the meeting went with a piece of paper slid across the table to the banks, telling them how much money they were now going to take from the TARP program, whether they asked for it or not, and that they had to sign a statement saying they were in agreement to that. Mm-hmm. Is his recollection of that meeting accurate? Is that in fact what took place? Again, not 10 days after we were told, the Congress of the United States was told that the TARP program, the money that was made available, be used for something entirely different.
Right. I was invited to attend that meeting. I was not involved in decisions about who should come to that meeting and who is going to get what. My role was confined to explaining the temporary liquidity guarantee program, the debt guarantee program, and that was the only remarks I made were to explain that program. And I did not opine or comment at all on the capital investments piece. We were not involved in decision-making, and we remained silent during that discussion. But yes, these banks were strongly encouraged to take this money.
Going back to your answer to my first question, though, were you troubled that day about what you saw taking place in that meeting? In light of the fact you just said that, you made 2 statements already today. You said you were troubled by this unprecedented involvement of the government in the private sector, and you also said, in an answer to Mr. Rice's question earlier, that the government should act as one. So were you sitting in that meeting troubled by what you saw take place in that meeting, again, 10 days after the legislation had been passed for an entirely different purpose?
Yes. I think 2 things. I think these decisions were made in the fog of war. These decisions had to be made very quickly. And the situation was becoming more and more destabilizing. And also, there had been an international agreement to use a combination of liquidity guarantees. We were involved with liquidity guarantees and capital investments to stabilize the system. Frankly, the idea of it took my breath away, and it was quite unprecedented in terms of the private sector system that we have. And so I was concerned, and I have said...
Was that the first time, did you know what was going to take place in that meeting, or did you come into that meeting much like Ken Lewis and the rest of the 8 other...
We were told in advance who was going to come, and that they were going to be asked to take or encouraged to take capital investments. We were absolutely told that in advance. I did not weigh in one way or the other. I confine my role to explaining the debt guarantee program. I have said in retrospect, I wish we had weighed in, because I think, again, government ownership in banks has created a whole host of problems. And by the way, on troubled asset relief, I still think we need a program, and we would like to see maybe perhaps Congress authorize that going forward. That still needs to be done and
Mr.
hasn't
Chairman,
been
if I could real quick, I appreciate what you said, Chairwoman. I think this has been very helpful. If I could just do one other question, Mr. Chairman. The talk this week is about using TARP dollars for stimulus for something outside of the
Right.
scope.
Right.
I mean, again, I think it was done already, but I totally disagree with this. Your thoughts, if you would, on the idea of using TARP money for second stimulus?
Well, I think you're asking me something beyond my pay grade, because I'd like to confine my public comments to areas where I think are appropriately fall within my sphere as chairman of the FDIC. I do think that there needs to be more focus in terms of troubled asset relief. We still have toxic assets on the books of banks, particularly the smaller banks really did not benefit from the capital investments. The smaller banks are a large share of small business lending, but their need to continue to work out and reserve against these legacy loans that they have is inhibiting their ability to engage in new lending. So we do think it would be appropriate and consistent with the troubled asset relief program to try to deal with that problem. But beyond that, I would not want to opine about other uses that others might want to make of the TARP money.
Gentleman's time has expired.
Thank you, Mr. Chairman.
Right. I now yield to the gentleman from Virginia, Congressman Connolly.
I thank the chairman and welcome Chairwoman Bear, and I'm going to ask you to move your mic closer. I
Yes,
cannot
please,
hear
I'm
you
sorry.
sitting here because of the acoustics in this room. I'm listening to my friend from Ohio, and he loves to use the phrase, this unprecedented federal intervention in the financial sector, as if we didn't have the worst meltdown in 70 years, a year ago, September. Let me ask you, wearing your FDIC hat, as somebody who has an interest in ensuring deposits in depository institutions regulated by the federal government. So what if we hadn't had that unprecedented federal intervention by a Republican administration, by the way? What would happen to the banking sector in America wearing your FDIC hat?
I think it wasn't pretty, it wasn't perfect. I think in retrospect, and hindsight's always has additional wisdom.
So should we have not have done anything?
No, we had to do something. And it
I'm
did
sorry?
we had to do something, and it did stabilize the system. I absolutely agree with that. Something needed to be done, and that was the decision that was made, and it did stabilize the
So
system.
intervention was necessary in your
Intervention
view?
was absolutely necessary.
Now,
At
the
that point, yes.
intervention that was designed, this came from some pointy-headed liberal academic from some Ivy League college, right? It didn't come from a Republican Secretary of State and a Republican administration, did it?
I'm sorry, what are you referring to?
Well, who proposed the idea of a TARP?
Oh, the TARP. The TARP was proposed by the Treasury and the Fed in 2008.
Oh, not a pointy-headed liberal academic from an Ivy League college, by a Republican businessman who was the Republican-appointed Secretary of the Treasury in a Republican administration. Is that correct?
Yes, that's my recollection of how.
If the gentleman would yield.
No, I'm not going to yield. Let me ask you a question. In your testimony, you say that you've got, wearing your FDIC hat, a direct interest in both Bank of America and Merrill Lynch because they are depository institutions. Is that correct?
That's right.
What
Merrill Lynch is not. Merrill Lynch
sorry?
Bank of America, the bank is a insured depository institution. Merrill Lynch was an investment bank.
I know, but I'm reading from your testimony.
Right.
Okay. And you assert that FDIC has a continuing stake in the financial well-being of those insured depository institutions.
Right.
Okay. So what was the view of the FDIC at the time the Bank of America proposed to acquire Merrill Lynch? Was that a good business decision? Was that a risky business decision?
That's right.
Were you aware of the fact that they had unprecedented losses, by the way, without unprecedented federal regulatory intervention?
Well, a couple of things. We are not the holding company regulator. The Fed is, and we do not approve mergers and acquisitions. The Fed does. We are also not the primary regulator for Bank of America.
I understand.
We ensure them we have backup supervisory authorities. So I think in terms of the more intimate knowledge of that situation would come from the Fed and the OCC.
As backup supervisor, frankly, we must rely on the primary regulator. If there starts to be troubles, then we move in, but without red flags. And no, as with those caveats, I was not aware until we got these phone calls and started looking into it that Merrill Lynch had such significant losses in the fourth quarter. They were quite profound.
Let me ask you, we have a bill that's pending before the floor of the House of Representatives today that would constitute a major overhaul of regulation, and for the first time finally allow some oversight of the risky derivatives market, for example, and would in effect extend some federal oversight and regulation of investment banking by any other name, not many are left, that none of which existed previously. In retrospect, just given your financial expertise, do you think we made a mistake to explicitly exempt derivatives, a multi-trillion-dollar market, from any federal regulation?
Oh, absolutely. That was a mistake.
So again, this unprecedented federal intervention in the financial markets, in the case of derivatives, since there is no such unprecedented federal intervention at the moment, maybe in retrospect we should have had some.
I think we absolutely should have had more regulation in a lot of areas, and particularly in OTC derivatives. There's no question in my mind about that.
Thank you.
Yes.
And my final question, does the FDIC have a point of view with respect to the extension of FDIC that's contained in the bill that's pending before the House today? Is that a good idea, to extend the FDIC and finance that extension by having the big banks have an extra fee rather than taxpayers do it?
Right. Yes, we do support. We have said that for banks and bank holding companies that have insured depository institutions, we would like to be the resolution authority. For non-banks, we will let Congress decide that, and I think they've decided they would like one entity doing it all. And yes, we think that this should be a very robust resolution mechanism that provides no open bank assistance, no conservatorship. Everyone goes into receivership. Their shareholders and creditors take losses. And that's the process that we use for banks, and that's the process that works. And so, yes, and we think the working capital needs for this fund should be provided through a risk-based assessment on the larger financial entities. And again, this could be another lever, another tool to discourage excessive risk-taking. So, yes, we do support that part of it.
My time is up. Thank you, Mr. Chairman.
Gentleman's time has expired. I now yield to the gentleman from Missouri, Mr. Lukenmeyer.
Thank you, Mr. Chairman. Madam Chairwoman, thank you for being here this morning. And just kind of curious, now that we have some non-banks that are banks, and Lehman Brothers has been absorbed by B of A, have you been in to examine that portion of B of A? Have you been in to examine the bank itself? Have you been in to examine like Goldman Sachs and those folks at all since this all took place?
We have, I cannot comment on specific institutions. I will tell you generally what we are doing, which is right now we have backup authority only for insured depository institutions. So activities outside of insured depository institutions, like investment banking, even though they might be part of a broader holding company structure, we have no authority there. That is the exclusive domain of the Federal Reserve Board.
Goldman Sachs is now a bank, is it not?
It is, no, because the insured depository institution is only a subsidiary of a larger bank holding company structure. Okay. This has been a problem for us. And another positive thing that we think the House bill does is gives us backup authority over everything in the holding company. Right now, it's only over the piece that has the deposit insurance, which is not the whole thing.
Do you think that there needs to be some ability to regulate and have some oversight over some of these off-balance sheet liabilities that a lot of these folks are involved
Absolutely. Yes.
What are your plans to do that?
Well, fortunately, the accountants have done a lot of it already. We are implementing FAS 166 and 167, which basically requires that these off-balance sheet exposures now be counted on balance sheet, so you have to hold capital and reserves against them. So we will be finalizing rules next week to make clear that you need to hold capital and reserves from the regulatory capital, that we will treat those as on-balance sheet assets. On the derivatives area, the OTC derivatives area, I think Congress needs to act on that. Because of the Commodity Futures Modernization Act, there is very little authority to provide product regulation or market regulation. And we've been working with the SEC and the CFTC to strengthen that, and we're generally supportive of that.
Okay. You made a statement a while ago that all our banks are in great shape, yet this last year or two here, we've had almost a record number of bank failures within a short period of time. Right.
I don't
Where do
know
you
that
see
I
this
said
going? How many more failures do you anticipate over the next year?
I would
2
not
years?
say, I think most banks continue to be profitable, but there are clearly some under distress. And we do not publicly release our fail bank projections, but it will continue to
understand.
go up. We think it'll peak next year.
Okay, but your comment earlier was also with regards to a lot of small banks are having to absorb some of these. They're part of the ripple effect of some of the big guys here and are certainly under stress at this point. Do you have any plans for some forbearance for those folks to allow them to be able to withstand this and to outlive some of these problems so that they're not going to be closed as a result of some of the actions of some of the big guys? And while we had forbearance with the big folks and helped them get over this, we don't have TARP funds available for the small guys. And if we don't have some forbearance for those folks, they're the ones who are going to suffer disproportionately compared to what the other folks is. And while it may not be a big deal to the folks who are concerned with B of A, it certainly is going to impact a lot of community banks in my district and a lot of small districts around this country.
Well, Congressman, by statute, if a bank becomes insolvent or can no longer meet its liquidity demands, it needs to be closed. There's a very well-defined prompt corrective action procedure in the statute. We cannot provide open bank assistance unless there is a systemic risk, and then only if the Fed and the Treasury and the President agree. So by statute, we cannot provide that.
With all due respect, Madam Chair, my question, though, is, are you going to have some forbearance on those folks because of the unusual circumstance that they find themselves in through no fault of their own, only being a participant in investing in some things that wound up getting them in trouble? And they don't have the opportunity, like you just said, for some of the TARP funds, things like this. Is there willingness on your part to look at these situations on a case-by-case basis and say, hey, the rest of the bank has been profitable, it's been under good management, that just this one area is a problem, and therefore we are going to deal with this and work with them on this and not close them down as a result of that? Is there a willingness to look at that situation?
There is. We have done that already. I think we released and were able to get interagency agreement on some guidelines recently that explicitly allow banks to do loan restructurings with the commercial real estate loans. It needs to be disclosed and well documented, and only if you have a credit-worthy borrower that continue to make payments on a restructured loan. We've tried to do that already. I guess my only point is, though, Congressman, once the institution no longer becomes viable under the statutory criteria, there is no flexibility to provide forbearance. And I think these rules were put in place after the S&L crisis, where it found there's forbearance and there's forbearance. And sometimes, if forbearance just denies the problem that exists and delays the closing, it will end up costing the government more money, which is what happened during the S&L days. So we do need to be careful. But absolutely, for the healthier institutions that can make it, we are trying to give them flexibility to work these loans out.
Okay. Thank you, Madam Chair. Thank you,
Gentleman's time has expired. I now yield 5 minutes to the gentleman from Louisiana, Mr. Gow.
Thank you very much, Mr. Chairman. And I'd like to continue questioning concerning community banks, similar to Mr. Luckemeyer, because in Louisiana, many of the banking system are community-based banks, and they are impacted tremendously by the financial overhaul that we are looking at in the Congress. Madam Chair, can you provide me with the number of banks that have failed in Louisiana?
I do not know that off the top of my head, but I will certainly get it to you this afternoon when I get back to the office.
Okay, but probably it's either none or extremely few.
I would really need to check. I'm sorry, Congressman, but we've had I think we will have about 140 failures, and it's very difficult to know state by state. I will get that information back to you very quickly.
That's fine. The community banks in Louisiana, they did not involve themselves in the subprime mortgage mess, and as such, many of them were profitable in the past years, while some of the big banks have failed. My question to you here is, why are we making these small community banks who were successful, who operated within the boundaries of the traditional loaning criteria, they follow the rules, why are we making them pay for the faults of the big banks through this tremendous overhaul process?
Well, I think two things. I think you're right. The community banks generally did not make subprime. They didn't make these high-risk mortgages. They did engage in commercial real estate lending. Some of that was not prudent. A lot of it was. They were good loans when they were made, but because of the economy, they're going bad now. And as the economic problems continue, more and more of the failures are driven by that. But again, banks must hold certain levels of capital and loan loss reserves against their loans. And if their loans are going to have losses that exceed their capital capabilities, they become insolvent. Or if they can't meet their liquidity demands, if depositors want to withdraw money and they can't have enough cash to do that, then they need to be resolved. And that is, again, there's a fairly well-defined procedure in our statute to do that. I think this Congress, again, back to the conversation about the appropriate use of TARP going forward and troubled asset relief, I think this is a ripe area, especially for smaller banks, to provide some assistance, continued need for troubled asset relief for the smaller institutions, and we'd be very strongly supportive. But our statute does not allow us to provide open bank assistance to large or small institutions, again, unless it's under this very narrow systemic risk
But it seems to me
exception.
that the small banks are being penalized for the actions of the bigger banks.
I think I am greatly troubled, and I have spoken out about this for a long time, of the different treatment between large and small. And the very large get the TARP money and get the support, and the small ones get closed. I don't like that. Going forward, I'd like to close the big ones too. I mean, I think that's really, if we're going to have a free market system, not a free-for-all system, but a free market system, I think going forward, the resolution regime needs to be able to work for small and large institutions, and right now it can only work for the smaller ones. But the immediate problem, you're right, it's not fair, and we have said that TARP we need to figure out a way to make TARP work better for the smaller institutions. And again, with troubled asset relief, not so much capital investments, I think that's a problem, but troubled asset relief, providing support there to help them get rid of these bad loans so they can make new loans. We're very supportive of that, and work with Treasury, work with Congress on trying to make those programs more effective.
Can you explain to me, I agree with you that the big bank institutions that were involved in the subprime mortgage loans, we need to have a better mechanism of overseeing their operations. But can you explain to me how regulating the smaller community banks that are already regulated by state law, how would that improve our country's financial health when they have been profitable, when they have been following the traditional methods of loaning, they would not involve or did not contribute to this financial mess? How would regulating them improve our financial health?
First of all, no Louisiana failures. My staff just handed me a note, so no failures in your state. I think we provide supervision, obviously, of small and large banks because they have deposit insurance. There's a government exposure there. If they get in trouble, we always protect the insured depositors. So with that comes prudential supervision, and that's been the case for over 75 years. I think moving forward, my concern from a supervisory perspective with the smaller banks is helping them diversify their balance sheet because of uneven, unlevel playing fields between large and small institutions, as well as between insured depository institutions and the shadow sector, the non-bank sector. Community banks have been relegated primarily to commercial real estate lending and small business lending, and they provide good support for their communities in those two areas. But they don't have much diversification. They got the mortgages taken away from them, a lot of the consumer credit taken away from them, and again, a lot of that has been driven through unlevel regulatory requirements. So going forward, I would like to see if we can change that to help them further diversify their balance sheet and get back to where we used to be with community banking, where they were in a position to offer a more full range of services to their communities.
The gentleman's time has expired. Let me announce that we have 3 minutes left on the vote, and of course we will return 10 minutes after the last vote. I understand there's 3 votes. Madam Chair, let me thank you very much for coming this morning, and we will now recess until 10 minutes after the last vote.